In this video, we're going to take a look at the pound US dollar exchange rate and why it remains such a popular market with traders. Hello, I'm David Jones from Capital.com, and this is the latest in our series where we look at markets that are popular with traders around the world. Foreign exchange has always been a popular market over the last sort of decade or so, and pound US dollar, because of what's going on with the likes of Brexit, for example, has had plenty of volatility. So let's get into it. Let's see exactly what is the pound US dollar exchange rate, how it works, and let's have a look at some of the typical volatility that traders have enjoyed over the longer term and the shorter term as well. So what is the pound US dollar currency pair, and why is it so popular? Well, put simply, it's the exchange rate of the pound against the US dollar. So for example, if GBP USD is trading at 130, it means that £1 buys you $1.30. It's a very widely traded currency pair, and clearly over recent years, because Brexit has dominated discussions, politics and the economy in the UK, there's been plenty of volatility, and it's this sort of volatility that has made it popular with traders. Coupled with that, because of the volumes the pound sees, it's a tight spread in terms of the buy versus the sell price. So the cost of trading is very low, and that's a feature through all foreign exchange markets that see lots of volume. So how do you trade pound US dollar with Capital.com? Well, you trade contracts for difference, CFDs, on pound against the dollar. And when you're trading using CFDs, you're trading using leverage. So you may be familiar with CFDs and the idea of leverage, but just to explain quickly, leverage has been used by short-term traders for many years across all sorts of markets. In a nutshell, what leverage does, it lets you magnify the size of your position based on your trading account. So trading this way, traders are hoping to magnify their profits when they're right. But of course, as ever in financial markets, if you're magnifying your profits, then you're magnifying the potential loss when you're wrong. So it's more important than ever to use risk control measures such as stop losses to ensure that losses are kept under control when the market doesn't move the way you were expecting it. And with CFDs, very important in all financial markets, particularly in foreign exchange, you can trade in both directions. So for example, over the last few years, we have seen some steep falls for the pound because of Brexit. So if you thought the pound was going to drop in value versus the US dollar, you'd sell short, and it's very easy to do that with CFDs. We've also seen some strong recoveries, and that's where you trade long. So you buy first, looking to sell out higher up and bank a profit. But the important thing here, you can trade markets in both directions when trading using CFDs. Let's take a quick look at some of the typical movements for the pound over the longer term and the short term as well. So I've gone right back on this chart just to capture the Brexit vote and show the sort of volatility we've had in pound US dollar over recent years. So the market peaked up around about 150 in June 2016. So that was where a pound would buy you $1.50. Brexit vote comes in, quite the surprise. And the market later on, October 2016, was trading as low as just above 120. That's a 3,000 point move, 20% fall in the value of the pound against the dollar. Claws its way back, jumps back up towards 143 by 2018, and then sells off again towards the end of 2018 and into 2019. Let's take a look at the shorter term. So we've gone from one extreme to the other here. We're now looking at just the last couple of days at the time of recording. The market has been as high as 126.40, has traded as low as 125.60. So even over a couple of days, we're seeing 80-point swings in pound against the US dollar. And it's this sort of volatility that appeals to shorter term traders, and this is why it's a popular market. So as ever with foreign exchange, tight spreads play their part. The cost of trading is low. Plus the sort of volatility we see in these markets, because they get moved by so many different economic, fundamental and political events, means they continue to be really popular markets with traders around the world. You can trade it through Capital.com using CFDs, contracts for difference. You're trading using leverage, so you've got the potential to magnify your profits, but hand in hand with that is the risk of magnifying your losses as well. So as I said, it's very important to use risk management techniques such as stop losses. Plus, of course, you can trade markets in both directions, which is very important. If you're a short to medium term trader, you need the ability to try and profit from falling markets, and that's what you get with CFDs. You can find out more about that on the Capital.com website. We'll start wrapping up this short introduction. If you're watching it on YouTube, you can subscribe to our channel and click on notifications to always be alerted whenever we upload new content. But for now, from me, David Jones and Capital.com, good luck with your trading.